Hello, everyone. Good afternoon. On behalf of the Women and Young Members Excellence Committee of ICI, it is my pleasure to welcome you all to Yashaswini, an Idol Series 65. Yashaswini, an Idol is a Wednesday series of programs conducted by Women and Young Members Excellence Committee for the women CAs and by the women CAs. This series is an extension of Sky High Symposium, which concluded its 100 episodes. It is one of the committee's initiatives to not only disseminate information to women members on technical updation and non-technical skills, but also to empower and inspire women members to come at forefront and realize their verbal skills at public forum. So I now I would like to introduce our first speaker, CA Sonali Johari. Sonali is a chartered accountant and a corporate finance expert with nearly 20 years of experience in transaction structuring, valuation, and fundraising. Specializing in health tech, fintech, and insurtech, she provides strategic consulting and training to startups, helping them to solve complex business challenges and drive growth. So over to you, Sonali.
Thank you so much, CA Sonia Rai. Good afternoon, everyone, and welcome to this very interesting session. I'm Sonali Johari, and I will, without much further ado, get started into a very interesting topic which we have selected for you today, which is the fundraise for a startup from seed to scale. I hope my screen is visible to all of you. It is an extension of one of the topic
Yes,
session I had done in past for the same series, and I believe it's one of the most topical and interesting aspect which, as a chartered accountant, all of us would get involved in or would want to get involved in for sure at some stage of our career. You're in a professional kind of avatar working at a corporate, you're working with an audit firm, in an articleship firm, in a tax advisory, whichever role you may be in, it is unlikely that some form of fundraising would have not touched your professional journey. So, what you'll try to capture in next 50 odd minutes is a very bird's eye view and high level introduction to variety of things, including equity life cycle of a company. We'll also try to kind of do a very quick dipstick into what equity is for people who may have not experienced it from a work perspective. As part of our curriculum, we are already aware and have learned about equity and debt, but some nuances around how it's used in the practical world. It's not just equity and debt in the practical world, it goes beyond that in various forms of equity. So we'll try to simplify that along with simplifying the series wise dynamics. And I love to say this, demystifying at times what does it mean when you say series A, B, C. And hence in my title, I included the reference of from series to seed to scale, equity versus debt. And then towards the end, I'll try to capture the procedure for private capital raise and a bird's eye view of an IPO processor or the initial public offering process. So let's get started. Uh, you know, as a company, this is just a kind of an indication we have done. It's obviously will vary from company to company, situation to situation. But any typical startup, when you think about over a period of time, will be raising funds over different means of sources of funds itself. When we try talk about raising the funds, we specifically talk about equity and not debt. As chartered accountant, we all know debt is the capital raised, which comes with, for lack of better words, an expiry date or a repayment date, right? So anything which is repayable, there are predefined terms or some manner basis triggers based on which there is always a repayment liability, and hence it's recognized as a liability on the balance sheet. That's debt. Anything which is that, not that, is either equity or a quasi equity, as we call it. And we'll talk about that also in a minute. What we have tried to capture here, what I've tried to mention here is visible is the revenue, which is on y axis, and over a period of time depicted on x axis. How does a company raise funds? And what does it mean from the overall cycle perspective? Typically, when a company gets operational, and a startup specifically, a lot of startups we all know even today are not profitable on a cash flow basis or on a EBITDA, EBIT net profit basis. They can still raise money. There's a valuation for those companies also available. And we have seen even IPOs happening for such companies. We call it value of debt, which is the left side of this chart, left bottom side. And there, the source of funding is usually angels, friends, family offices, Seed capital is what we call it. That's the capital required for putting in the seed, contributing to the growth of the initial phase of the business. Then comes to the early stage, later stage, which is done by venture capitals, VC, acquisitions, mergers, strategic alliances, and there are different kinds of funding before eventually the company gets publicly listed in an IPO. So, if we were to think about the forms of capital, there's a startup and fast growth. For startup, you need speed capital, which means, and again, I always say it, I'm a banker, investment banker by profession. As a banker, we all love jargons, but most of the times, while these jargons may sound overwhelming, they literally mean what they say. Seed capital is basically like a seed is grown, to kind of, grow up as a plant. Similarly, seed capital is the basic capital, the first level of capital which a company raises, which works as the manure, I would say, rather than seed, but in the contributes in the growth of the company from day one perspective. Venture capital, venture is obviously more riskier to that extent, is the capital or growth capital raised at the early stage. This is all privately done, and hence it's also called private capital raise. Once a company has reached steady state, you will see a company doing an IPO, which, as the name suggests, initial public offering. That's the first public offering a company can do on these stock exchanges. In India, on BSE and NSE, companies get listed, and retail gets an opportunity to participate. Though in recent times, you must have all come across unlisted shares acquisition. So in an unlisted market, also nowadays company shares are available. It is unlikely to find them at an early stage unless you're part of the core family, you know the founder well, or you have some other angle around it. But these are the equity capital market products which company has access to either raise capital or to provide exits to existing investors, which is called secondary transactions. Let's first deep dive into stages of fundraising in a startup. This is a very, very rough sketch I have presented before getting into a very formal table for you to appreciate and understand the nuances of different stages. The pre-seed idea stage, this is literally when a founder is thinking about, oh, I have an idea, I have a brain wave, I want to start business, but guess what? I have idea, I have energy and time to invest, but I don't have money to invest. And that's when you go out and raise pre-seed, idea stage, or seed stage capital. Then you have Series A, you'll have Series B, C, and beyond. A is more when a PFM market fit. For the product is established, when the regulatory overhang is taken away, when you are in a business, you know that okay, there's no regulatory concern, at least prima facie. Oh, this product is something where market exists, people are willing to buy it, engage it, those kind of things. That's when normally, as a thumb rule, you think about it as Series A. B, C, and beyond are nomenclatures. Every next series is called B, then C, then D. There is no limit to how many series you may raise. They are for mostly growth expansion. It's called growth capital series. And then you have late stage of pre IPO. This is usually one series before private capital, last cap private capital, where you will see before the company is getting listed. It's most common to see the unlisted shares getting traded. You can see it today. It was happening for HDB for last few years, which got listed just 2 weeks back on the Indian exchanges, the subsidiary of HDFC Bank. It is happening today for NSE, for CSK, lot of companies, Hero Motor Corp, all of these companies, where in the late stage, the shares are also now coming and seeping in into the unlisted market. And then you have IP and public markets. What I'll be doing is in next few slides, I will be talking about some of the more nuances of each of these stages. Before I go to that, I want to highlight two specific aspects related to startup funding for you guys. The instrument is equity shares, that's direct ownership, voting rights, and dilutive, right? However, very commonly, so what I mentioned started with earlier, we know as a chartered accountant what is equity, what is debt. Now, obviously, equity guys are the last one to get paid. They're the ultimate shareholders and owners of the company. They get maximum upside, but their capital is also not protected, and hence they're exposed to a significant downside. Debt, on the other hand, have a prior commitment for repayment of principal as well as interest. So the risk and the risk metrics, equity is on extreme left, debt is on extreme right. With over a period of time, because of the investor appetite, because of their preference for particular kind of risk measure, there are instruments which are mezzanine or mixed instruments, which have some forms of debt and some forms of equity. Convertible notes or convertible shares or preference shares are all sitting in between. They're not debt, they're not equity, but they are a mixed instrument. They have some characteristics of a debt, some characteristics of an equity. These instruments are the most commonly used instrument for funding in startups. A convertible note is basically a debt instrument converting to equity with subject to certain milestones being achieved. Now, these milestones can be timing. These notes I'm investing today will convert into equity 2 years down the line. Or a business milestone, these will convert into equity when company raises, clocks a revenue of 100 crores or is able to raise another major round of 100 crores. Whatever those milestones are, commercially decided. Benefit from an investor's perspective, these gives them a priority or a preferential treatment over equity holders in case of a liquidation or a wind down of the company. Plus, they can be an interest component while they are treated as notes. So, as an investor, why would I think about it? Well, I've got certainty because they're convertible into equity to get the equity exposure with some downside protection around capital because of the preferential treatment over equity holders and some recurring income in form of the coupons associated with such convertible notes. No immediate valuation is required, and the conversion can be pegged to a later date. So, as an investor, I have certainty. I'm happy to come in when a bigger investor comes in, but I'm not today pricing the round. It's very common for family offices or angel investors, ultra HNI investors, when investing in early stage of the startups to invest through the convertible notes route. CCPS, as the name suggests, is compulsorily convertible preference shares. Now, there can be a lot of variants, optionally convertible preference shares, um, you know, non irredeemable preference shares are not allowed. So you'll have obviously a convertible, but it can be a non-convertible debenture kind of thing, non-convertible pref shares. CCPS, again, in that hierarchy, if I think about equity on the left side, debt on the right side, convertible notes sits more closer to debt, CCPS sits more closer to equity. These are preference shares that can convert to equity. Again, the benefit is they're hybrid, they're very common in India. This is the most common instrument for funding in startups. Across cities, when you think about it, the nomenclature, you'll be surprised how kind of interesting it is. Series A, the instruments issued in Series A are typically called Series A CCPS, Series B CCPS. So obviously, like I said, as bankers, we love jargons, but in almost all the cases, or most of the cases, if not all, the jargons literally mean what they say. So these are normally different CCPS according to the series under which they are being issued. The interesting one is SAFE, SAFE. Now, this is a product which is very relevant for startups, especially in the early stage. It's future equity agreement. You are basically entering into an agreement as a founder today with potential investors where you're not diluting today, you're not committing to a valuation today. It is founder friendly, there is no interest, it is equity, it is flexible, and it gives the investors ability to get a foot in the door to be able to invest and get that ensure and get that comfort and certainty of allocation and ability to participate in a equity offering in future. From a founder's perspective, it's very quick, friendly for founders, no interest and flexible, and you get money on day one. These are very common when there are founders who are already have a very good track record and there's no dearth of capital and they're not willing to raise capital today. But then there are certain investors who wants to back them and they say, okay, come what may, you take our money today, give us equity shares tomorrow. Now, what instrument works for which situation purely depends on what you're solving for, who you're solving for. Again, on which side of the table you are. Are you advising the founder? Are you advising the investor? Will also kind of indicate and impact what what would be your preferred instrument in this entire scheme. Let me now take you through and I'll spend kind of good time on this and the next slide because these are very data oriented slide. But I have tried to club everything in single slide, despite knowing that it can become data heavy, is because it's important to do a side by side comparison to appreciate the nuances of each of these in a better manner. Bear with me while I take you through this table, and this is very important and interesting and can be a reference guide. One heads up, this is indicative representation based on market precedents, and each situation can be different. So there is no casting stone. Like chartered accountants, as chartered accountants, we have always learned and we know, okay, this is right and this is wrong. In a lot of these private capital raises, it's not right or wrong. It all purely depends on what are you trying to solve for. The legal regulations tell you the bare minimum of what needs to be done, but it will not and never govern you when to raise, how much to raise, from whom to raise, at what valuation to raise. What I've tried to capture in this slide is basically to give you a one single snapshot of different series and across series how to differentiate and think about them. There are two slides in this breaking up this information. I'll take you through the columns first for you to understand it before we get into the detailing of each series. What I've tried to think about is what is the typical tenure? What is when you raise pre-seed, seed, series A, B, C, D plus plus, because I've seen companies jumping from Series C to pre IPO to exit. I've seen companies raising all the way to Series G and then still not thinking about pre IPO. So, again, no casting stone. It purely depends and varies from situation to situation, company, founder, investor, market, lot of factors which play a role here. When is the typical tenure when these are raised? What is the typical raise size? These are all US dollar millions when I'm talking about. Key investors, again, not an exclusive, exhaustive list, it's an inclusive list, trying to just give you a perspective of investors because each investor will have a different preference of when to invest and where to invest. It's also important to understand the investor's decision to invest varies and comes from the perspective of their risk appetite because higher the risk, higher the return, lower the risk, lower the return, the cardinal rule of investing. Hence, whatever the investment mandate investor has, it's depending on that they will think about, um, you know, that which series they'll be comfortable with to invest in. Which are the key investors, the bankers' involvement, and what we'll talk about is typical money valuation, pre-money and post-money. I will spend few minutes towards the end of this session on what is pre-money and post-money, key influencing factors, and is profitability expected, bare minimum, required or not required across the series. So pre-seed, of course, that's when companies just starting up. It's 0 to 1 years typically. And the raise is you would not want to, as a founder, raise a lot because your intention is to raise as much required to scale up the business without going through a dilution. The typical investors in the pre-seed and seed, I'll club these two, will be angel investors, accelerators. You must have heard about Y Combinator. A lot of accelerators in India which have picked up of late. Techstars, and mostly informal advisors. These are usually word of mouth. Oh, I know the founder. Founder reached out to me. I introduced it to a group of my friends. Those kind of word of mouth works. Seed is typically 1 to 2. Once you've done the pre-setup, you may still be in a pre-revenue stage, but you've already done the base work of setting up the company, seeking the regulatory approvals, getting a base team in place, right? 1 to 5 million is what you may want to raise, just so that it gives you at least a 6 to 12 months headway to get to a product market fit, to get to an established situation. Seed funds, there are specific niche funds which only invest as seed capital. Angels, micro VCs, venture capitals, first round capital, and semi venture angel investors are also growing up. Optional advisory, otherwise, again, networking helps here a lot. Then comes the series A. Now, in my mind, this is kind of, more from the early birth to a teenage situation. Think about it that way. Series A is really a litmus test. Here, if you can get backing from an early stage VC like a Sequoia, Excel, A16816, A91, a lot of these Bloom Ventures in Indian context, these are all early stage VCs. There are boutique advisory firms which may assist here. Again, word of mouth works wonders here also. You may want to raise 5 million to 20 million. This is the first test by an institutional investor because normally, most commonly, it is in Series A when you get your first institutional investor. Now, if an institutional investor comes on your cap table, is willing to take exposure, that is a very positive proof of the concept and kind of commitment, conviction for the broader market. It gets you a lot of media publicity. I don't know how many of you would be enrolling it to a lot of these articles like VC Circle, Ken, Rise and Shine, Capitaline, a lot of these which are published on a daily basis and with weekly summaries, which kind of highlights some of these fundraisers very well. Even Economic Times, Mint, whichever newspaper you pick up, you will find references to the fundraisers. There was a reference in ET today morning itself, referring to a startup raising 2.5 million. Now that When I say money is raised, I always say this to all my founders and my clients. Color of the money is green, but still you get few things along with it. One is you get money in the bank account. Color of the money is green. Whoever you raise doesn't matter. Money is money. But what it gets you beyond that is publicity. That's the best marketing event. I did a couple of IPOs. One of them was when I was working as the company representative itself. I used to head the investor relations and FP&A for that company called HDFC Life, and our CEO used to always say back then that for me this is the largest marketing event also, which is true. The outreach you do with an IPO, with a raise is much more. So when you raise capital, you also want to make that as a way of letting world know a company like this exists, especially at Series A level, Series B level. So while in a fundraise you get money, which is color is green, it's in bank account, it's good to have, and that was the primary objective. You also get some value add aspect. If someone like giving an example, Berkshire Hathaway decides to invest in a company, that goes a long way because people believe that okay, an investor like Berkshire Hathaway would have done huge amount of diligence. If they are convinced about the business, that's great. We have seen that trend even in listed companies, right? So, what is the kind of branding, conviction, market publicity you're getting because of that raise? That's the qualitative aspect. The third critical aspect which a fundraise also gets you is networking ability. If it's an investment by, I'm just taking an example, say Bloom Ventures or Sequoia. By virtue of becoming a Sequoia investee company, you get access to and connect with all the Sequoia senior guys across the globe, plus all the other investee companies, which can be your suppliers, your potential customers, or just in the ecosystem a participant to organize things better. So there are a lot of qualitative aspects also which happens with a fundraise, and that increasingly become more relevant beyond Series A, if you ask me. Series B and C, well, these are just tenure driven, 3 to 5, 4 to 6. You will see there's an overlap. You will raise anywhere between 20 to 50 or 50 to 100. I would club all these to say everything beyond Series A till pre IPO. Now, these are early stage VCs or more so growth stage VCs, late stage VCs, crossover funds. You will start seeing some amount of secondary transactions also happening at this stage. And typically, there's an often involvement of bankers which starts coming in. These are not the traditional bulge bracket tier one banks, which deal in more larger transactions like Goldman's, Morgan's, JPM's, Credit Suisse, Nomura's of the world. But they may be the small boutique niche banks which exist out there. Then we talk about Series D plus plus or pre-IPO, 100 to 500 million. Now this is when private equities come in. They don't want to take early stage exposure. Though in the current scenario, almost all the established private equities have also set up a venture capital fund. Sovereign wealth funds, crossovers meaning Fidelity, Temasek, BlackRock, Blackstone, a lot of these. Majorly investment banks are involved and the banker involvement is high. And then you have IPO where mandatorily a banker is required. There will be public market investors and institutions. The transaction size typically will be 100 million plus. It can go up to 1 billion, more than 1 billion also. Like the HDB IPO, which got listed just 2 weeks back, was 12,500 crore. That translates into, at the current exchange rate, round about $1.4 billion. Before I take a pause on this slide, let me take you to the second part to it. What is the typical valuation we think about for each raise? Now, pre-money and post-money valuation, park that for a minute. I'll come to that in a minute. But the typical post-money valuation is the valuation after the raise is complete, after you've received the money. Pre-money valuation is the valuation of the company today before you've raised the money. Now, in simple example, pre-money valuation plus the amount you've raised is equals to the post-money because the value of the company will not change immediately because beyond 1x of the capital amount you've raised. Post-money valuation is the number which you will look at when thinking about the percentage shareholding for investors and so on and so forth. The key factors for pre-stage seed are team, the idea, strength, founders backing, accelerator, affiliation. All these things play a role. Mostly people don't expect profitability to happen at this stage. Seed capital, it's still a MVP progress, minimum product viability or minimum viability of the product is still in progress. You may have an early traction, you may have got a good founding team members. Profitability again is secondary. Series A, you've got the product market fit. As I said, this is kind of, that teenage of a company where, not in years perspective, but in principle, where you start seeing the characteristics, the character of the company in totality. So, product market fit, user growth, monetization signs. Again, people are practical. They don't expect company to be profitable by this time. Series B is basically where people start thinking about profitability. That is there an approach to profitability? Gone are the days when in early 2005 to 8, there was a euphoria for startups and no one was willing to even think about profitability. Or early 2000 dot-com bubble, where a lot of you guys, I don't know, I'm a person who has been in this industry for 20 years. So I was in my school in 2000s, but those were the days when the businesses were sold just on the number of clicks, number of visits to the website. Those days are gone. People now expect the founders, expect the corporates to think about profitability, and hence approaching break even or thinking about profitability is important. Revenue growth, unit economics, and scalability becomes the key factors influencing the valuation. And normally, a Series B may have a valuation of anywhere between 70 to 200. I know it's a wide range, but I've seen companies even doing a Series B at 50 million to 100 million also. Series C, well, around 200 million, strong financials, expansion, and market share starts becoming important. And normally, possibly, profitability is appreciated. Again, there'll be exceptions to everything. I will repeat, none of this is casting stone. It is all an indicative representation based on the market precedents, based on the experiences, and what kind of series which are happening today. So it's all pure market intelligence, personal experience. Series D or IPO. Now, this is where often profitability is important. Again, this is not a prerequisite. In Indian context itself, we have seen companies getting listed, especially startups like Zomato. When it got listed, it was not profitable. In fact, it has started giving some green shoots only in last few quarters when in a single digit percentage margin, you will start seeing it from Zomato plus Blinkit. But profitability is not a prerequisite mandatorily, legally, but investors are increasingly getting towards it. Near IPO readiness, strategic metrics becomes important. How will you expand all the business evaluations that happens? So in these two slides, and hence I gave a caveat beforehand that I know they are a bit of data heavy, but the intention is for you to get a good perspective of what different series includes. And these are the critical ones to think about from seed to scale. How you think about what is the series we are talking about? What are key investors? What, as a chartered accountant advisor, I can do? Banker involvement is where also CA involvement comes in. I have towards the end captured a slide to highlight what is the kind of CA as a chartered accountant our role can be in each of these. Pre-money and post-money, what I had mentioned earlier. So pre-money is the company's valuation before new capital is raised in the funding round. Post-money is simply after the new capital, and post-money is pre-money plus new investment. Dilution, that's the reduction in existing shareholders' ownership after new shares are issued. That is in percentage of ownership, not in value. In a simple example, if I had invested in a company and I had 10% stake, I invested $10 and the company valuation is 100, my stake is 10 upon 100, correct? And these are number of shares, right? Valuation is now increased from 100 to 200 and company is raising another 50 capital, right? What will happen is for 50, they are going to issue only 10 new shares. My shareholding in the company will be, I had originally 10, I continue to hold that 10, but the total share capital is now increased from 100 originally plus 10 new raised. So it's 10 upon 100. It's reduced from 10% to roughly around 9%. That is the dilution of 1% in my shareholding. But my value of the stake, now I have 9%. I have just rounded off the numbers for simplicity and conversations here. 9% of 250 instead of 10% of 100. So while my percentage shareholding has reduced, right? But my value of the stake has increased. If I apply that 250 into 9%, my value of the stake is 22.5. When people think about pre-money and post-money valuation is the valuation of the company, pre-money as an as-is plus the new capital raised. So post-money in my example will be 200 plus 50, 250, where 200 was pre-money and new investment is 50 itself. That's I'm just trying to give you perspective of few key terms so that when you hear in startup context, you know what they mean. That's what post-money valuation is. How an equity capital is raised. Let's quickly talk about the process now. Um, Primary markets and secondary market. Now, these are more in the context of listed space, but you will always also see secondary nowadays in unlisted space. The shares you buy in private markets in an unlisted space today, for example, of NSE, are all secondary shares. The difference? Primary is when a new shareholder comes in the company and when company issues new shares. Simply, if the company is the beneficiary of the consideration and company is issuing new shares in lieu of that consideration, those are primary. The new shares issued is primary. When an existing share is being sold, that's secondary. In my example, when company issued 10 new shares to raise 50, that is primary. Now imagine a situation, I want to sell my 10 shares instead of company raising new capital. When I will sell, who will get the consideration? I will get the consideration. Is company involved in that transaction? Well, not practically. I'm a seller, someone is a buyer. They will pay me money, I will get them shares. Company's involvement to that extent is restricted to only the change in their shareholding table. Now, instead of Sonali Jory, the name may say ABCXYZ, right? That's the only rule. So, primary market, when new shares are issued, it's newly listed issue. When the existing shares are being traded, they are called secondary market. Mostly historically, secondary trades used to happen only in stock market. So in stock market, when you buy and sell shares, through any of your broker apps, Zerodha, Grow, HDFC, ICICI, Kotak, whichever you're using, what you're doing is you're dealing in secondary market. Now, types of equity. We discussed there's equity and there's debt, which is what we have learned. Types of equity, well, there will be hybrid, preference shares, convertibles, deposit receipts. Typically, the common stock versus preferred stock, the difference lies in the fact that um, both are form of capital. This is common equity versus debt rather. Equity is not redeemable, debt is redeemable. Equity is permanent, debt is not permanent. Fixed interest, equity has no interest and there's a variable dividend. Debt has interest and no variable dividend. There's no security guarantee for equity. Sky is the upside, but bottom is no cap. Debt, limit on the upside, but limit on the downside, like risk reward. Risk, there's yes in both, but higher the risk, higher the return. So in equity, there's a higher risk. In debt, there's a lower risk. Exchange traded, both equity and debt can be traded. When we think about preferred stock, it sits in between. It is a form of capital, yes. Is it redeemable? Yes, subject to certain situations. It's permanent? No. Does it have fixed interest? Well, it can have coupon. Does it have variable dividend? Normally, you will have coupon predefined, so variability is not included. Is there security guarantee? Well, it's more than equity, less than debt. There's a risk, yes, but again in between the two. And normally, if it's a standardized equity pref product, it will be exchange traded, not that common in Indian context. So preference shares, are basically the shares which are issued, which have a preference over equity shares. In a wind up ranking, if a company was to unfortunately go down a liquidation, the last one to get paid is ordinary equity. The first one to get paid, apart from advisors, insolvency practitioners, which is also a very interesting area of operation for chartered accountants, subject to complying and completing certain courses. But there are fixed charge holders, there are preferential creditors, there are floating charge holders, unsecured, fixed charge are also secured caller. Nomenclature again will vary. Subordinated debt holders, then preferred equity, and then ordinary equity. Now, this is very, very important and relevant one. Wind up rankings, or as we also call a liquidation preference, is a very, very critical analysis and evaluation when a company um, thinks about raising capital, and also from an investor's perspective, when an investor thinks about you know investing in a company, where is my risk? What if things go southwards? How risky is it? What are the chances of me recovering my interest, my return, my capital? And hence accordingly, this takes a huge relevance and importance for a company. Let me move to and give you perspective on the procedure for private capital raise and IPO, which is something, as part of when you think about a fundraise from seed to scale. As a chartered accountant, we should also be aware of what is the process of raising capital. Normally, be it series A, B, C, D, E, F, anything in private side will have similar aspects, similar procedure. Timelines may change, detailing may change. Like I told you earlier, the slide which I showed you earlier, what is relevant, key influencing factor, this will impact and imply and change the extent of diligence required in the transactions, and the overall, hence the processor involved. So let's now talk about the private capital raise timelines and process. This is an illustrative private process where the kind of competitive sale process can take 4 to 6 months from start to finish. Now, remember, this is more detailed. So, this is, if you ask me, I've given you a detailed one so that if it's a shorter one, it can't go beyond 6 months. Hopefully, fingers crossed with the markets in going in the direction, in the working in their favor also. But normally, a preparation phase can take 4 to 6 weeks. If you will see, that is the maximum time involved, right? Then you have another 5 weeks for marketing phase, enter the market. Now, if it's a small company, as you can guess, for a pre-seed seed, there's not much of preparation phase. There is not much of diligence requirement. So automatically, the entire prep phase can reduce to 3 to 4 weeks. Enter the market invitation marketing phase. This is when you start reaching out to investors. And as a chartered accountant, the role we can play is also facilitate that preparation, handhold the management, the reach out to investors, the marketing phase in terms of marketing, meeting investors, sharing with investors, potential buyers, the teasers, having a call, sign the CAs, which is confidentiality agreements, distribute the procedure letter and CIM, the confidential information memorandum, and expect at the end of this preliminary non-binding bids. Now, again, depending on the situation, depending on the urgency, depending on the markets, depending on the demand, you can do this as a one stage or a two stage. You can ask for a non-binding bid, then do due diligence and get the binding bid, or you can do one shot. Just sign the term sheet, do the confirmatory DD, and move on. What is right, what is wrong, purely depends on what are the circumstances, what are the factors, what are the pros and cons, and what you're trying to solve for. At times, founders will say time is of essence. I don't want to do two stage. I'm happy to share my data, in which case you may share more information upfront. If it's an early stage, anyways, the diligence is not that time consuming because there's not much to do diligence on. It can be differentiated. There is another approach also done in these cases is vendor due diligence. As part of your preparation phase itself, you try to do acquirers due diligence by hiring third party vendors. Now, typically in this situation, when it comes to vendor due diligence and financial due diligence, as chartered accountants, that's one core area of operation for the CA firms which exist. You must have heard about financial due diligence, which is undertaken to prepare either on the behest and mandate by an acquirer, potential acquirer, or the company itself getting it done with an ability to give that report, reliance report to the potential acquirer. So again, I'll conclude. This is not a casting stone. This is an indicative, illustrative process for you to get a sense. Once you get the final bids, you have the final negotiation, transaction documentation happens. Um, Depending on the nature of the transaction, the documents will be signed. For example, SHA, shareholders agreement, is signed in all cases because that determines the, the shareholders' intersay of how to manage the company. That will lay down the rights and responsibilities of founders, the rights and responsibilities of investors, board representation, various private matters like reserve matters, affirmative voting matters, do's and don'ts for founders, lock ins, all those things. How will the business operations of the company managed is governed by a shareholders agreement. SSA, share subscription agreement, is signed when there's a primary raise involved. Mostly in early stages, that would be the case. Company will be raising capital. So SSA is signed to determine the terms of subscribing to shares. SHA tells you modus operandi of how the company business operations will be managed once the share money has come in and the shares have been issued. SP is a document signed share purchase when there's a secondary involved. When an investor is investing either through primary or secondary or combination, they will sign SSA for the primary portion, they will sign SPA with the seller for the secondary portion, and SHA that, okay, together I will have, say, 50% shareholding. These should be my rights. I should have a board representation. You cannot do ABC things till you have my confirmation, which are called AVMs. A lot of these things. Again, we can have a separate session and I'll work with the team to see if that's of interest to organize such a session where what are the key terms involved are. But all this is done in final negotiations and signing of definitive agreement. So if you think about it, the typical competitive sale process will take anywhere between 4 to 6 months. Um, Field of potential buyers will be reduced in each phase. It's a funnel. Think about it as a funnel. You're filtering You may reach out to 50 people. Of 50, only 30 may come back and say, okay, we are willing to sign an NDA or a CA, non-definitive agreement, or a confidentiality agreement to take a deeper look, take a kind of more closer look to the assets. Of this 30, you will share the details. 20 will come back and say, not working, not interested. 10 will come back and ask for more details. Or say 15 came back and asked for more details. 5, after looking at more details, dropped out. 10 other people who came back and said, okay, we're willing to give you a non binding bid. Now there will be a pricing, valuation, price discovery. Some will work, some will not work. You will filter out of that 10 odd to say, okay, these 5 looks interesting. You go back to them and say, okay, can we do due diligence? Now this can be 5, this can be 2, this can be 3, or this can be 7, 8. Purely depends on situation to situation. Obviously, what is most important as an advisor to them and in the entire process, confidentiality. Ensuring that the investor is right. That's one job as an advisor, and ensuring the information being shared is confidential, it's watertight, and not being misused. You have to be very careful if you're looking at a strategic transaction not to share too much information with competitors or investors of the competitors. So those kind of second level thinking needs to be undertaken as well. Key documents to be completed. You have in the preparation phase, you will prepare a teaser and a confidentiality agreement. In the marketing phase, you will have an information memorandum, a data room, which is normally historically used to be physical. Nowadays, everything in the virtual data room. A process letter laying down the process. Okay, we are sharing you this. This is additional what we can provide. Is a data room with access to ABC things. You have to come back to us by this date with a non-binding bid. This is the format in which we want our binding bid. Whatever the details are, you put that down. In the due diligence, you'll have a sale and purchase agreement, revised process letter from here on, financing agreement if applicable, and a binding bid letter. And the final negotiation and completion, you will have pre-completion documents, heads of terms, which is more like a term sheet, key heads, final sales and purchase agreement, SHA, and then closing documents, disclosure schedule, all those things. So this is a bird's eye view of telling you what a process for a private capital raise looks like. Let me now change gears and go to an initial public offering. Now, I'm sure all of you have heard the term IPO. Indian markets are buzzing currently, and the number of IPOs which are lined up to come to the Indian markets is humongous. It's not a joke, it's kind of money expected to be raised. What is an IPO? IPO is an initial public offering, the first public offering of a company, signified or symbolized by the company's shares getting listed on the stock exchange. So, in Indian context, when a company gets listed on BSE and NSE, its shares are available to be traded, to be bought and sold by retail investors also, and obviously institutional and non-institutional. That's an IPO. That's usually the first formal setup in which you are seeking interest from retail investors and also giving them an opportunity or a platform to buy and sell subsequently. Why does company thinks about an IPO? Of course, first prime reason will be to raise capital, growth finance, but capacity extension, strengthen capital base. But more importantly, there are certain other aspects. You're creating the value, crystallizing the value for the company. You know, avatar, you know, okay, this is the valuation of the company. But in reality, unless there is a market out there which tells you every day, oh, this is the valuation, it's not signified. Especially when it comes to ESOP, stock option plans you may have given to employees. So an IPO gives you the valuation, crystallization of value for stock option plans. It creates as a marketing initiative, effector on products. It's the retail company. Suddenly everyone knows about this company. Attractivity for employees increases, research and development, mergers and acquisitions using now stock as a currency is possible, and obviously getting the funding for product development, R&D, growth finance, capacity expansion. So, like I told earlier, color of the money is green. You can raise money from public sources or private sources. Why would you do an IPO? Because it's also create getting you in that, you know, big boy angle. So it's from teenage moving to adulthood. You know, we are now grown. When you're listed, um, people think about you as a more regulatory driven company. There are certain in the banking financial services, BFSI, RBI, IRDA, these regulators are asking companies to get listed by a particular time, like HDB IPO. RBI had told HDB because it was upper tier circular, under the upper tier circular, because it was one of the largest NBFC in the country, you have to get listed. So there can be those figures also. Option holders can liquidate, it creates an acquisition currency, continued access to capital, and obviously gives the options for all the investors which came before IPO to exit and monetize their stake. The cost of going public can be pretty high, by the way. It is not a cheap affair. You will have to spend, you will have to comply with regulations, and many people don't realize that it's not a preparation to get IPO. You should prepare to get listed. You're living in a glass house post that. So it is extremely important that you think about, all the nuances and the regulatory compliances required after the listing itself, right? So that's the cost of going public, can be anywhere between 3 to 5, 6%. Again, larger the IPO, smaller the percentage, smaller the IPO, larger the percentage. You also have to think about leaving money on the table. A typical IPO process is what I've highlighted on this slide, which can be broken down again into four buckets like private, preparation, filing and marketing strategy, marketing and pricing, and then closing. Obviously, no price for guessing. The detailing and the nuances which go in an IPO are way more than that go in the private market for two, three reasons. One, it is highly regulatory driven. And that is because of the second reason that it involves way higher number of investors and especially retail investors. As a regulator, rightly so, whenever retail is involved, the kind of supervision, the kind of restrictions increases significantly because with all due respect, retail don't have access to the most detailed information. It's usually the institutional investors who have access to information. So SEBI, in Indian context, Securities Exchange Board of India, governs the entire process to ensure that there's nothing wrong, nothing which is not good for retail investors is wrong for them should go in their hands. The whole preparation phase involves big amount of time around prospectus drafting. uh, the first draft, which is submitted to SEBI for the IPO. Now, this can be confidential or a public filing. Mostly, if it's confidential, then you have to go down the public filing route anyways. SEBI has introduced these new regulations, allowing companies to do confidential filing also when they are not confident on timelines, but they still want to be prepared. But even once that is done, you have a process of filing draft red herring prospectus, or as we call it, DRHP. Once that is filed, SEBI reviews it. The whole procedure of making that is governed by the ICDR regulations in Indian context. It's called Issuance of Capital and Disclosure Requirement. ICDR regulations by SEBI. They're like the Bible, the guiding light for an IPO. You have to ensure adherence to all the provisions of that. Plus, SEBI also asks investment banks, merchant banks as they call it, which is a mandatory requirement for any IPO to be hired by a company to comply with any past observations they may have given, which are again available in public domain. So it's a pretty exhaustive task. A draft red herring prospectus, DRHP, can run into, I've seen, back in the days, 15, 18 years back, they used to be 300, 400 pages. Nowadays, it's common to find DRHPs of 600, 800 pages because there's a lot of minimum disclosure requirements out there. So the entire preparation phase can take anywhere between 2 to 4 months. Once that is done, SEBI's review period can take anywhere between 2 to 3 months. The analyst briefing, pre-deal, filing the draft red herring, and pre-marketing. Once you have that, and you have SEBI's approval, long, higher, broadly, you would be anywhere between 4 to 6 months from the start date. You start the marketing and pricing. Now, in Indian IPO context, the if you're doing a big build IPO and there's certain compliances around that, minimum 35% needs to be offered of the net IPO needs to be offered to retail investors, 15 to non-institutional, and 50 to QIB, or as we call it, institutional investors. You will do marketing and pricing for institutional as well as domestic. And based on that, you will find the price band. You will announce the price band before the red herring prospectus. Now the draft words goes away. You file the RHP, which is submitted to the ROC, and then you kind of go ahead and get the IPO started. So that is the broad bird's eye view of an IPO process. Okay. The key things which, as an advisor, we can get involved in valuing the business using comparable companies. Main selling proposition is established. Accountants and lawyers will undertake due diligence. So that's one very important area. As an auditor, you will be required to give comfort letters, circle up for the numbers which go in the DRHP, RHP, and prospectus. The draft red herring prospectus, and prospectus. DRHP is the draft document submitted to SEBI on which comments are given. RHP is actually the marketing document in which you will issue the timeline. The price band is issued later. And prospectus is after the IPO is done. Uh, it includes the details of the numbers, shares issued, the pricing at which issued. That ways. Lawyers will prepare listing application, bankers will work with the management team, and they will start putting together the prospectus. This is a bird's eye view of telling you what all the prospectus covers. Its initially price range will be blank in the DRHP, even in RHP. The raw requires the SEBI asks allows us to disclose the price band at least 2 working days prior to the issue opening. Risk factors for the company. What are the risk factors an investor should be aware before investing in this company? The timetable and schedule, what's the timelines, regulatory information, company and management description. I always say this to anyone who is trying to understand and look at a company. If there is any IPO document in recent past, that is the best information. That's the Bible, that's the most exhaustive encyclopedia on the company. Principal shareholders, selling shareholders, financial statements, capital structure, details of share offer. All these information will find its way in the prospectus. Investors' buying decision will be based on the information on prospectus and the management meetings. So it's called a liability document for this very reason, because in the prospectus, you will get a sense of the overall, um, you know, what kind of the sorry, I think my screen share. 1 second. I'm just going to reshare my screen because I just had a technical snag, I guess, in my screen share. Okay, sorry about that. I hope my screen is visible, right? Tech team, if you can confirm me, please. Okay, hopefully no news is good news. Um, so yeah, prospectus is the document in which is the basis for the entire thing, which happens in terms of the with the entire thing. In terms of the marketing documents. Now, as an auditor, as a chartered accountant, one of the core role we get involved in is circling up or giving comfort on these numbers for bankers and management. Roadshow, that's a terminology used in IPO, where you go out and physically meet investors. Investment bankers will help plan that, and that becomes critical for a company to think about getting the pricing information, intimation, feedback for a price discovery. So that in totality becomes the process of an IPO, right? From start to end. The process of an listing all the way can take anywhere between 6 to 9 months from the start of the work internal preparation. Before I conclude this session, I have a last slide which I wanted to show you, which is role of chartered accountants across different stages. Again, this is not an exclusive list, this is an indicative one. In fundraising, for valuation, for preparing models and due diligence. More importantly, for compliance related to ROC, FEMA, tax, shareholder docs, etc., is something as a chartered accountant we all can play a critical role in. On a regular basis for audit, governance, etc., we have a role to play. And in IPO, there is DRHP, there's preparation of India's financials, preparation of audit, circling up of documents. All those also becomes very critical. As a chartered accountant, our role can be fairly detailed oriented across each of these. With that, I will conclude my session. I hope this was relevant and useful. I know it's quite a lot of information to digest in short span of 1 hour, but my objective of this session was to give you a perspective of different series, what is the private raise, IPOs, and a very high level, elevator pitch or 70,000 feet overview of the process in each of these situations. I will take a pause now, and in case, team, there is any question from any of the participants, please let me know. I'll be more than happy to answer the same.
Hi everyone, this is Tanaya. First of all, I would like to thank you, C.S. Sonali ma'am, for sharing wonderful insights on the fundraising process. Not just that, but like sharing everything, the entire end-to-end structure. I'll take up some questions which few people have asked. One is coming from Sandeep sir from Thane. He has asked like if you could just elaborate on the institutions or any private entities from whom funds can be raised, like as per the categories from seed level till scale level.
So I had in my slide included some references. Again, it's a very,
Yeah,
very wide list if you'll appreciate. And it's a list which is
yeah.
changing every day as we speak, right?
Okay.
If you refer to the slide, the key investors section, one second. Yeah. If you refer to the second last column, key investors, which is illustrated, these are the different types. For example, early stage VCs include Sequoia, Excel, A16, A91, Bloom Ventures. A lot of these,
Mm.
again, this the list is exhaustive. It'll run into thousands of names, not just hundreds. So those are the kind of ones. For example, when we say sovereign wealth funds, Temasek, GIC, Khazana, Adia, Mubadla. Um, LIC has not done in private side. They do it in IPO or post market more so. Like LIC recently in HDB IPO was one of the key, that one, not one of the, it was the largest anchor investor in the HDB IPO data. So again, the list is very
Yeah.
exhaustive. What I had tried to capture for this very reason is to give you the category. If you think about that category and you start looking into that category, it can give you a lot of names like private equities in Series D plus will be Warburg Pincus, Chris Capital, GI, GA, General Atlantic. Again, I can keep on saying the names Advent International, Gaja, but yeah, you got the essence of it.
Yes, yes. Noted. Yeah, it's pretty. Um, there's one more question. Um, just a minute. Um, okay. There's one question which is coming from Sandhya, who is from Chennai, and she wants to understand how, like, what would be the, like, if you could share your insights on how to become an advisor to a venture capital firm.
Um, so, an advisor to venture capital firm, you need to think about what is the value add. What are you advising on? Are you advising the venture capital firm on where to invest? Then you need to have networking with a way to know who will be raising capital because venture capital will invest in seed stage or series A and pre-seed, right? You need to have a network
Right.
of good companies that you know when these companies in any of these series are raising capital. Because what are you adding value? Again, what I'll go back is what are you trying to achieve? You are trying to add value to venture capital firm.
Mm.
I am guessing that is to help them identify the opportunities, unless you're trying to become their advisor from an audit perspective. But remember, these
Mm.
companies are too early stage in their business, so there's not much data to audit on. You will be investing. A venture capital firm invest more on the whole idea, on the conviction, on the industry, the founders. So it's more hunch, it's more of sixth sense, it's more of your intangible aspects which drives the value and investment thesis for a venture capital rather than just the solid ones. Solid numbers, physical, tangible information is only a supporting actor in that case. So if you're being an advisor to those people, then you need to think about what are you advising or helping them on? What are you creating value for them on? If you want to help value, the one logical thing I can think of is introducing them to good startups, which means you should have a good network and inroads to know who are the good guys, who are the good founders, have early access to those deals, and then you can raise it and present it to venture capital.
Right. Makes sense.
Again, none of these are
Um,
cookie cutter solutions or answers, guys. It's more of logically stepping back and thinking. I always say this to, I've been an investment banker my life, that it's not NASA. It's not like we have to launch a rocket where precision to a last degree is important. As a CA, we look at precision. But in investment banking, in advisory related to these aspects, you also need to be precise, be clear. Perfectionism is very important, but equally important is logical aptitude. Just be solution oriented around things and think about stepping back and saying, okay, why would someone be even keen to engage me? What am I getting on the table? And then can you differentiate that? That's the way I would think about it.
Right, absolutely. Um, and okay, um, there's one more question from Sandeep ji from Thane. He has asked, like, where do alternate investment funds fit in this capital raise?
So
Mm,
AIFs,
yeah.
alternate investment funds, is a new category, right? Very good question, I should say. It's it's a new outfit. Let's think about it that way. It's a packaging or a modus operandi of a of how the fund has been established, right? AIFs is also private equities are also set up as Indian AIFs. VCs are also set up as Indian AIFs, and you can have AIFs in form of pre-IPO funds also. So AIF is the modus operandi of how PE, VC, SWFs, or any other investor invests. Even family offices can have AIFs. It is not a new category of investor. It is an institutional investor, or other way you can think about it is AIF can be broken by same ways that they invest in Series A, Series B, Series C, unlisted, listed, that ways.
Understood. Um, so, okay, I think that would be it with the questions. Again, I would like to thank you, C.A. Sonali ma'am, for these really wonderful insights on the topic. I would like to thank ICI for helping us organize this, where we have a common platform to come share knowledge, gain knowledge, and yeah, I would like to thank the organizers who've made it wonderful for all of us. Yeah. So yeah, and I would like to thank everyone who's attended this for helping us make this such a good success. Thank you. Now
Okay.
I'd like to pass it on to the next session.
Yeah. Thank you so much, guys. Over to you, Kaju.
Hi everyone. Thank you, Sonali ma'am, for giving us such a sharing so much good information and giving such a insightful session. Now, I would like to introduce our next speaker, CA Kajol Chaurasia. CA Kajol is an internationally certified image consultant and a qualified chartered accountant with 4+ years of corporate experience in financial reporting at a top MNC. She is passionate about empowering women. She helps them in transforming into a confident, impactful version of themselves through her power of styling and image consulting. So, we all are excited to hear you, Kajol. Over to you. Welcome you all, and welcome, Kajol. You're not audible, Kajol.
Okay, am I audible now?
Yeah. All good.
Okay, thank you so much, Pooja, for such a wonderful introduction. So, yes, let's start. Honestly, a very warm welcome to each one of you. It's a pleasure to be on this platform where, uh, such excellent community, like where, empowerment, growth, confidence, everything takes place at its core. And so, today's topic is deeply personal yet universally powerful, that is self worth, right? And we are living in a world where we are constantly, where everyone is constantly telling us what we should be, right? How we should look, and where or how much we should have achieved by a certain age. So it has become extremely important for all of us to protect our self worth and to believe and to stick by who we are. So I will share my slide. Just give me a moment. Okay, so is it visible to all of you? Okay, I hope it's visible, right? So today's topic is a gentle reminder and a strong wake-up call for all of us to protect our values, to know who you are and to protect your self-worth and never let your self-worth get affected by any other person's opinion. So let's start with the topic. Okay. So everyone has a story. So I believe all of us in this room are CAs, and we all have a story of strength, resilience, where we didn't give up, right? I would love to share my own personal story, which I think all of us can resonate to because we all are chartered accountant. That's the beautiful part of this session. So I was pursuing my group two IPCC, and it was my sixth attempt, and I cleared my CPT in first attempt. I cleared my group one in first attempt, but my group two took almost 3 years of internship. And when I was writing my paper, I was extremely vulnerable, and all all I was thinking that whether I will be ever be able to become a CA. And all everything I was thinking was all about what other people will be thinking, what I will be doing, what society will be telling, what my family will be telling. And it was something that another world going on in my head, and I am writing my SFM paper, strategic management paper. And that was the day, I think, I don't know what I wrote in my exam. And miracle happens with those who don't give up. And in that attempt I cleared, and that too with exemption in all three subjects. And that was the moment where I was like extremely proud of myself. I realized that my thinking of me just having 40, 45 marks and clearing CA is wrong. I am much more than just 40, 45 marks. I can be those people who have exemption. I can be those people who have 70, 80 plus score. So I believe we all have those stories of strength and resilience. And those are the stories which empower you to be your best version and not forget who you are and to protect your self worth. So let's start with this next slide. What is self doubt? So let me tell you, self doubt क्या होता है? For example, you are sitting in a meeting, you have a question, there are 100 people in a room, and you are just thinking whether I should ask this question. And okay, does this question make any sense? Will people laugh at me? And you have a lot of things going on. So, what is happening? You are just self doubting your own abilities, your own question, your own decisions, right? And it is holding you back from taking action. Always remember, self doubt is not your own voice, it is the echo of someone else's expectation. So, never self doubt yourself. I mean, that's my personal opinion because the moment you start self doubting you start degrading your self belief, your own worth, and things start following each other. Now let's understand what is self belief. Self belief is the deep rooted conviction that you are capable, worthy, and enough regardless of the circumstances and validation from others. So in in one word, what we call self belief in Hindi, Atmavishwas, right? If you believe yourself, you can turn the stones, right? Even if you have enough resources, even if you have a lot of skills, even if you have everything, but you don't trust yourself, you won't be able to achieve what you want in life, right? Because self is the first thing that comes that will keep you striving for your dreams, that will make you believe even during your toughest time that you are enough, that you will win, right? So it's very important to know what is self belief and to stick by it. Now let's understand what is self-worth. So self-worth is the internal sense of being a valuable and a worthy person regardless of your external achievements or opinion. It's very important to know like who you are, right? What are your capabilities? You don't need any external validation to know your own worth. You know who you are. You know uh, from where you are coming, right? What you have achieved in your past, because we all have a different book, we all have different battles to fight, right? And hence, very important to know who you are and what you have achieved in your life and to know your own worth. Now, let's understand how all these three concepts are interlinked to each other. First, self doubt. The more you doubt yourself, the more your self belief system will get poor, right? मैंने जितना ज्यादा खुद के ऊपर डाउट किया, I don't know like what I'm doing, right? I have a lot of questions. I'm thinking so much that it's stopping me from taking action, right? So my belief system will be automatically poor. And what will happen consecutively, it will lead to a fragile self-worth. And if your self-worth is fragile, then it will lead to again self-doubt, because you are doubting your own abilities, you are doubting your own worth, and hence you are always in self-doubt. You are always seeking validation from others about your own capabilities, your own abilities, your own future plans, and it is a endless cycle. So read it with me. To be yourself in a world that is constantly trying to make you something else is the greatest accomplishment. So we are living in a world which is full of external expectations where everyone wants you to be in a certain way. But it's very important to be yourself, because you are your best version and you know what you can accomplish, what you can do for the world, being your own version. Okay, sorry. Okay, so now let's understand from where this self doubt comes from. Number one, childhood conditioning. So, if you're someone who has grown up in an environment where you were always being told that you are not good enough in something, you are not like other child, you have not achieved like some other child, and you are always facing facing circumstances which are not actually good for your health, like for your life as you are growing kid. So those things what you have faced in your childhood becomes your conditioning. Your even after growing up you have lot of doubts about your own worth, your own abilities. You are full of self doubt. Number two, rejections and failures. If you have faced rejections and failures, for example, there are so many people who are not able to clear CA in 3 to 4 attempts. It takes almost 10 to 12 attempts, and I admire their strength and resilience. But it somewhere gives them a lot of self doubt, right? But at the same time, be it an interview or anywhere. So when you start facing rejection after rejection, or failure after failure, it starts affecting your own belief system, right? And it leads to a lot of self doubt. Number three, social media comparison. Trust me, social media, the way we see, is not actually behind the camera. Even I have been a content creator, and I know to get that perfect picture, there is a lot of hard work required at the back end, and I read somewhere IIT guy is telling on the social media that this rebel kid called Apurva Makhija, this girl is earning per day 2 lakh just to say anything, on the social media. And I am staying away from my family and studying day night and still not able to earn that much. I believe that this is the impact of social media. We are comparing our life with someone else's life, and we're not able to see behind the camera what is actually happening. And honestly, no one is bound to share their bad moments on social media, because no one is concerned about what is happening in your life. Everyone is there to feel entertained, to get entertained and to see nice things which gives them pleasure. So it's very important to understand and not get thrown by what you see on the social media. Number four, perfectionism. If you are having a very high benchmark for yourself that, okay, I have to be perfect in something and then only I will be feeling satisfied, then you are giving rise to self doubt, because we are human. It's not possible for us to be 100% perfect in something, right? There is always a scope of error, and you have to forgive yourself for that matter, because you are human, not a robot. So, the more perfectionism you will want in your life, the more chances of self doubt you will create. Because if you are not able to meet that expectation you have with yourself, you won't be feeling good about you, and it will lead to self doubt. Now, understand what is the impact of self doubt. So earlier we saw like from where we get all these self doubt, sources of self doubt. Now we have to understand what happens if you have lot of self doubt, right? Number one, procrastination. As I said, in if you have a question in a meeting full of 100 people, and you are not able to, your self doubt, which is giving rise to a lot of overthinking, will hold you back, and it will stop you from taking action. You will think like, okay, कोई बात नहीं, अगली बार मैं पूछ लूंगा, बार बार ये सब चीजें होती रहती है. So you will procrastinate your action. Number two, people pleasing. Since you have a lot of self doubt, you are not trusting your own abilities, you are not trusting your own, uh, what we say, capabilities. You are trying to please others to, with a hope that they will be favoring you, they will be making you happy in certain some or the other way, right? It leads to people pleasing because as your own, because you are doubting your own self, and to compensate that, you are trying to get that favor from others by being nice to them. And number three, external validation. This is the most common thing which happens when you have lot of self doubt. External validation is, for example, I am wearing a dress, I have to go for a party or anything, and I am asking everyone in my family, every person sitting there, like to my husband, to my mom, to anyone, everyone, that am I looking good? Am I looking, well dressed? Or so be it anything, you are always seeking external validation, that the other person should tell you that you are looking good, you can do it, you cannot do it, so the more you depend on the external validation, the more self doubt it will create. Trust me, external validation is something you should always avoid. It is very important to understand your own instinct, to understand what you really want, to understand what you really, what you really want, what you really are, right? And comes the ignoring opportunities. What we call ignoring opportunities. If you have self doubt about yourself, if an opportunity comes, you will be doing so much overthinking that you will end up uh, saying that it's okay, opportunities keep coming, let me give myself more time and I will try to grab that opportunity next time. But trust me, you will never get the same opportunity twice. And so self doubt leads to all of these things, and it is never a good, it is never good for you. Now the case study says like women tends to apply for a job only when they meet 100% of the job requirement, and whereas men, they will do so when they are meeting just 60%. Trust me, I think we as a women are more on the conservative side. We are more considerate about the requirement or be it anything in our life, So we need to take more care of ourselves. Now, it's a reminder to all of you that your value does not decrease based on someone else's inability to see your growth, right? I think every time you feel low, always read this quote. It's a empowering quote. I think every time I read, I literally love it. So let's see how to avoid self doubt. Now, first thing comes self awareness. It's very important to be self aware, like, what are the things that are leading to self doubt. The moment you are able to understand what's happening inside you, you will be able to treat that particular thing, you will be able to overcome it. So, number one, how and why am I feeling? For example, you had a bad day in the bad time in the morning. You had a argument in the train or anywhere, and now your whole day is going on toss, and you are all the time just thinking, "Aaj ka mera din hi kharab hai," But you need to sit alone and you need to think like, why is this happening? Why am I feeling this way, right? Automatically you will get an answer कि okay, मेरे साथ maybe in the morning ऐसा हुआ था, because of that in the back end I'm not feeling good, and that is why my day is not going that good. Number two, whose voice is fueling this self doubt? Always remember, every time you get a self doubt, it is not your voice, it is someone else's expectation. You are just thinking about others, you are not thinking about your what you are feeling that moment. You want to do something good, but you are thinking about others, their expectation, what they will do. And number three, am I sharing my stuff to the right person? Remember, it's very important to share your plans, especially critical things, to the right person. The moment you share things to the wrong people, they will feed 100 negative things in your head, and you will end up procrastinating thing. You will end up doing something you didn't really want. Number four, what unique contribution do I offer? It's very important to know what is that unique thing that you can offer to the world. For example, you want to start a business, you should be very clear what is that unique thing that really you can offer to the world. For example, I knew that I want to do something where I am sorry. Yeah. So, for example, in my case, I knew that I want to help people. I want to see those smiling faces. And honestly, I was not clear like how, when I am going to do, but I was always clear about what I want. And I always wanted to work directly with the people where I am able to see those happy faces. And I ended up being an image consultant. And honestly, speaking, every time I do a transformation and I see those confident faces, it really gives immense happiness to me. Number four, replace inner criticism with compassionate correction. So, what happens every time you make a mistake or you are criticizing your own willingness or ability, your own worth? Do not do that. You need to replace those negative things with the positive things. Because the moment you start filtering your own system with the positive things, automatically the change starts happening within you. Now, this is the activity I will request all of you to do. Write down three wins you are proud of, big or small. We forget how far we have come. So I would request all of you to just revisit your past and recall those three, minimum those three wins where you were vulnerable, but you didn't give up, and those are your proudest moment that make you believe in yourself, that protect your self-worth, that you rise to immense self-worth, that I am something. Now, rewriting the script, overcoming self doubt. Now we know that how to be self aware, right? Now, what we have to do, we have to rewrite those wrong narratives with the right belief system. Number one, stop seeking external validation. So, this is the most common thing which happens with most of us. So, this is the most important thing that we have to stop, right? You have to stop seeking external validation. For example, you are going for an important meeting, you dressed in a way, you see yourself in the mirror, you like yourself, you are feeling confident. That's enough. You don't need to ask 100 people asking, like, how am I looking? Is it appropriate, or am I going to make any sense? Or you don't need other people's opinion as long as you are satisfied, right? Number two, stop self-doubting and overthinking. So the moment you stop self-doubting and overthinking, I think overthinking is something we all do. Even I do a lot of overthinking. And believe me, 80% time my overthinking is all waste. It never happens only. But what happens because of overthinking, you are wasting your energy on something that is really not going to happen. And in that matter, for that matter, you are missing on something that you can really work on and you can really achieve, that you can really make sense of, right? And the third one, stop oversharing your feeling, plans, and decisions. See, it's very important to share what are you feeling, what you have, what your plans are. But do not overshare it, because every time you share, for example, you have a new business idea and you are extremely passionate about it, but you are sharing it with 10 different people. It's good if you're sharing it to two, three people who are really close to you, who will empower you. But if you're sharing to everyone, trust me, out of those 10, eight people will be someone who will be feeding negative things inside your head. Why you shouldn't start your business. They will be telling you, how will you manage your own expenses? I think you should give some more time. You should not leave your job. And a lot of things they will tell you, right? So it's very important to protect your own plans, not to overshare anything, whether it's your future plans, whether it's your feeling or anything, because this world is full of people who don't want you to grow, right? And who don't want you to see happy. And trust me, this is harsh reality, but this is true. We have very few well wishers, and we all know that who those people are. start reminding you of your past achievement. So every time you are self-doubting, just sit alone. I'm telling you every time sit alone. But trust me, every time you sit alone and have a talk with yourself, it views, it kind of help you understand yourself better and know your own self and better and try to protect your decisions, what you are doing wrong, what you're doing right. So it's very important to spend some time with yourself and remind yourself of your past achievement every time you are doubting yourself. Now, how to reclaim your self worth. So let's see how you can do this. Dress like you matter. Trust me, every time you are dressing your best, you are communicating your body, your mind, your heart that you matter. And if I matter to myself, it becomes implied for world to respect you. You know, you are not demanding respect. You are telling world that I am something and you need to respect me, right? Your your personality, the way you dress is something that people see before they even speak you. So dress in a way that you tell world that I am already successful and you need to treat me this way. And trust me, dressing well gives immense boost to your self confidence. And the moment you feel good inside, the moment you feel confident inside, you will always act, good because it will get reflected in your behavior. Number two, set non-negotiable boundaries. If you are I know it's good to be a good person, to be available for others. I was also like that, honestly. I was always like, okay, if I'm helping someone, it's a sign of good person. But trust me, every time always saying yes to everyone gives them a feeling that they start taking you for granted, right? You need to protect your energy, you need to protect your space, you need to tell world that I have other business too, so you need to say no in a humble way. You don't need to be guilty of that, but at the same time you have to protect your own energy and peace, and set those boundaries where like when you have to say yes and when you have to deny this in a humble way. Number three, curate your circle. So we all have heard in our childhood, हमारे parents कहते थे, संगत का असर पड़ता है, right? So that is really true. If you are living in a circle, जहाँ पे आपका जो सर्कल है, it's always about कौन सा रेस्टोरेंट एक्सप्लोर करना है, कहाँ जाना है ट्रिप पे, क्या ड्रिंक लेना है, एंड क्या करना है. They are always talking about fun and life. You will be never able to share your business ideas. You will be never able to share what your long term goals are, because those people will be laughing at you, because that circle is not for you, right? That is not meant for you. On the other hand, if you are living in a circle, if you have a circle where people are good professionals, they have achieved something in their life, they're talking business, they're talking growth, and if you share your plans to them, they will give you 100 advices, they will empower you, they will uplift you, they will admire your thought process. So it's very important to live in a circle that is correct, that boosts your energy instead of draining it out. Number four, celebrate your small wins. So trust me, you need to set milestones. You once you start setting small milestone, and you connect to those milestones to something, a reward, right? It will boost your confidence. For example, I set a small milestone. For example, I want to complete my audit, and once I have completed my audit subject, I will give a self treat, right? And so, what happens every time you set a milestone, you achieve that, you celebrate with yourself, it gives rise to, it boosts your confidence, boosts your self worth, it gives you a sense of happiness that yes, you made it, right? And so, it's very important to Keep a confidence journal, revisit whenever you feel low. I think this is something not everyone is able to do, but it's always good to sit alone, spend time with yourself, and recall everything from time to time, whatever you have faced in your life and how you have overcome it. It automatically gives rise to your to self-confidence, and it reminds you how worthy you are. Number five, speak kindly to yourself. I know we all make mistakes, but it's very important to every time you make a mistake, instead of feeling guilty and thinking about it whole day and night, just need to sit alone and talk to yourself that it's okay, this has happened, maybe this was my mistake, but it's okay, it happens with everyone, we all are human, we need to treat ourselves with love and compassion. Especially you need to treat yourself with love and compassion, because your body knows how you are treating it. And sit alone and just be compassionate towards your body, be compassionate towards your mind, what it is thinking, and feed it with good thought, feed it with love and grace. That's how you protect your self-worth. Now, this is the transformation story of Reshma. She's one of my client, and when she came to me, she was literally like, "I feel so inferior when I am in a group of 15, 20 people. I feel so average. I don't know why, how bad I look like. But what happened? I was like, no, you don't look bad. We can improve on you. You look extremely beautiful." And she was like, no, I don't look beautiful. So remember, it's not about the face, it's about how you represent yourself. And we worked on her personality as per her job profile, as per her lifestyle. We worked on a lot of things apart from her appearance. And when I put her final transformation, and the happiness she had on her face was extremely, I can never forget. She was so confident, and she was like, I feel like I work in some managerial post in some good company. And that was the confidence boost which I was able to see just by changing how you appear, by working on yourself. So every time you spend time on yourself, you are not wasting your time. Trust me. You are telling your mind and body that you matter. And I am ready to make that extra effort to value yourself. And the moment you start valuing yourself, to start automatically things flow from inside out and everything comes into the place. So these are the some positive affirmation to reclaim your worth. I would request all of you to repeat with me, and I think please take a screenshot of these. Every time you feel low, every time you have some self doubt, please read these aloud. So I will read now for all of you. Please pay attention. I dress and live every day as I am the heroine of my life. Number two, I am enough exactly as I am. I do not need to prove my worth to anyone. Number three, I trust myself to make bold, confident choices that honor my value. Number four, my voice, my presence, and my ideas matter. I deserve to be heard and seen. Number five, I radiate confidence, strength, and self respect in everything I do. So these are the really powerful, quotes that you should always read out whenever you feel low. And with that note, I would like to thank you. And yes, please know your worth, protect your energy, and value yourself. So, anyone have any question? I would love to take it. Pooja?
Komal, are you there?
Yes, I am there. Anyone have any question?
Yes, ma'am. Komal, there is a technical glitch in our system. Just a moment.
Okay, okay. Okay, okay.
Hello. Hello. Yeah, thanks for wonderful speakers, CA Kajal Torresia ma'am, for apprising us, and also my gratitude for all taking time to join the session and taking it successful. Thanks for session. Can we further move toward question? Hello.
Komal, ma'am?
Hello. Yeah, can I further move toward those questions? Hello.
Hello, hello.
Hello, ma'am.
Yes,
Hello.
yes, sorry. Yes.
Can we move toward the questions? Hello.
Yes, the session is over. If anyone has any question, please do ask me. And I think your voice is a bit breaking or like,
Yeah, it's audible now, correct? Hello.
yes, yes. Now
Hello.
it's audible. Yeah, yeah.
Okay.
If we have any questions, we can take those one.
Hello. Hello. Please write those questions if anyone has those questions.
Sorry.
Participants, please have a question if you have a question on the session.
क्या बोल रही है? हेलो. नहीं 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 कोई प्रॉब्लम नहीं है. वो मैम को वो पूछ रही थी ऑडियंस से कि पार्टिसिपेंट कोई टाइप ऑफ क्वेश्चन करे. Ma'am, there is a question that from Jayashree, Bangalore, and she wants to have she want to start working after a long break. So, is it possible if you can just advise her?
I think break is something we all take, right? We as a woman, I think it's undeniable to take a break, right? And break is not a stoppage to dream, right? So even if you have taken a break, it's possible to start whatever you want to do, like uh, whether you want to start your own business or you want to have your own job. In whatever way you want to join a company, right? So it's never impossible to join after a break. It is definitely possible. All you need to do is just get into that momentum. If you want to start your own business, start doing research, start doing business setup, start seeking advices from people, how to do it, how to make it. And if you want to join a job, try to gain some skills side by side. Start looking for the companies that truly take people who have a small career break, and accordingly you can find a way. You will definitely find a way. It can never be a problem to take a break. It's a necessity. We all take break at some or the other point of our life.
Thank you, ma'am. Ma'am, there is one more question that how to maintain the consistency. Sometimes it can happen when we try to self care.
Consistency. See, consistency is not something uh you have to do everything, sorry, every day, right? Consistency is something that you have set a milestone you have to achieve, and to achieve that you need to do a small contribution every day. For example, if you feel like, okay, I was able to follow my schedule for 1 week, but in the second week I am not able to follow that. Instead of skipping whole week, just try to do at least some part of it. Just forgetting something in between is not a consistency. Or doing everything every day, whatever you have planned, is also not consistency. Consistency is be into that momentum always till the time you achieve your result. So always try to stick to what you have planned. Even if you are taking a break in between, you are not able to follow that, it's okay. Don't worry. But from time to time, just evaluate what you have done and then restart and start from where you have left, and without losing your momentum. Yes. And it's really possible. And please try to understand consistency is something we all struggle with, but it's always possible. Without losing your momentum, you can always be consistent. I hope that answers your question.
That's all, ma'am. Thank you so much for your valuable time, ma'am.
Okay, thank you so much.
Thank you.
Sure, sir.